So Larry, I've already ranted about how I'm not a big fan of this theory that bonds are down because the bad number means we're getting more stimulus, but I don't want to skew your interpretation, so hit me with what you think and let's talk about it.
Yeah, I think that's what, the narrative that we're going to see now, perhaps for the next 6 months, is that the market's going to explore the upper bounds of where it belongs. And my call has been 1% by the end of the year.
Love it.
Not easy to get there. But given the vaccine, that's what the market cares about right now. It doesn't really care about the BLS report. That report had to be a huge miss for that to change the overall themes of the market. And so all that to say, the market is trying really hard to ratchet up and find the upper bounds. I mean, let's face it, the 10-year Treasury had a 163-point range this year, and now it's just trying to attempt to find equilibrium, and maybe 1% is it right now.
I love that, Larry, because first, you're looking at it from a technical perspective. You're saying this thing is in trend. You've been here telling us to be ready for continued bond weakness. You've been right about that. And you're looking at the price now instead of trying to find some nice Christmas wrapped, narrative around it. And as I like to say, I like narrative as much as anybody else. But again, today there's a big piece missing if your narrative is that it's all about stimulus, because usually the dollar dives when there's stimulus news and repricing. And we didn't get that today. It actually firmed up like we got good data almost, as we've seen with vaccines and other action as well. That has been the only time we get any, support in the dollar. So when you look at that, what does it mean? I mean, does it mean that bonds are just, to your point here, in a trend and we shouldn't try to fight it?
I wouldn't say we shouldn't try to fight it. I just think it's just trying to find equilibrium. And I think there's a lot of what we call volume bulges between around that 1% area where you're going to have a lot of knee-jerk reaction to if yields continue to climb higher. But all that to say, the market really cares right now about time. Is time going to heal the economy? And the vaccine seems to suggest yes. And the pathway is going to dictate the shape. So all that to say, 1% seems to be like perhaps a little bit less net, but 1% seems to be like the equilibrium right now that the market's trying to fight for. And it doesn't seem to be, it does seem like a big deal to you and me, but when you consider where 10-year treasuries were a year from today, getting at 1% is not that big of a deal.
Okay, so Larry, I think also when you look at 1%, right, that's where we were in June when we first got through the main COVID wave and thought, hey, maybe this thing will be done soon. And all of our reopened stuff, rallied and the yield spiked, and then bam, it didn't last very long. We aren't even to that level yet. We're flirting with it right now. We're at it as we speak. And to me, that's why aren't we even higher? How come we're not past that? Isn't the outlook today much more obviously hopeful, optimistic, and bearish for bonds than it was in June?
Yeah, I would like to say so, but I think there's a couple of things that are throwing a monkey wrench into it, and that is the continued hope or fear of some type of fiscal stimulus package being passed by Christmas break. You also have people on both sides of the fence with regards to quantitative easing, weighted average maturity extension, and so that's kind of keeping a natural cap on yields, because if the Fed ends up buying longer duration, that's going to keep tens in check, and I think that's what's happening right now.
That's the big one, Larry. I think the point to end on here that's really important going into the Fed on December next week, right? We're going to get. Yes, thank you. So the calendar. If Powell doesn't say something, then what does that mean for bonds? Because I agree with you. It seems to me right now that the bond market is holding back because it thinks Powell is going to extend bond purchases or something. Is that whisper building, Larry? And if it doesn't happen, then what does that mean for bonds?
Yeah, I've been just worried about that all day, because I for one, don't think they're going to extend weighted average maturity on the 16th. I think they're going to wait one more meeting. And again, it's just my opinion. I'm trading that way. I'm not doing so well accordingly. But I do think if it does not come to fruition, then we will see tens rally a little bit more, up maybe 1 to 110 area. But getting above 110 is going to take a lot of doing. and it's never easy trying to find an upward bound. But if you're like me and don't believe they're going to extend wham in December, you should think that yields would creep ever so higher between now and then.
Okay. All right, Larry, really good stuff. The last thing I would say is if today is not responding to some new stimulus measure, then it seems that if we do get stimulus, that's even more bond negative if it's not pricing in. Let's say we get $2 trillion instead of like one or some shock like that, would be bond negative, right?
Yeah, no, you would be. And that's one thing that they definitely said, the Fed said that, they're not going to do. And I think the market's putting that in place. And so you have that offset by inflation and inflation expectations. Even today with the average hourly earnings report that came out better than expected. So that's kind of weighing or mixing into the whole thing. And it's going to be very fascinating to see how it comes out even next week.